Ever wondered how the money is created in the economy? How a handful of people in the world sitting in government and central banks can affect the wealth transfer from millions to a few, or rather, can also affect the incentive of opening more businesses just by a few decisions. Let's discuss. So, in today's session, we are going to discuss how the money supply in the economy is created and what are its effects. Understanding the money supply in the economy would mean that you would understand one half of the global economy. And why I say that? That is because almost every transaction in the modern economy consists of two parts. One part is that I either buy goods or services, and the second part is, or the second half is, I give money, sovereign money in most cases, in lieu of those goods and services. So money is one half of the transaction, and hence understanding the dynamics of money supply, how it is created, what it affects, who are the players controlling this, would make you understand one half of the global economy. Now, why the understanding of dynamics of money supply is so important? As we discussed before, money supply forms half of almost all global transactions. Now, no doubt the money supply forms one half of all global transactions, but it's one of the most inferior storage of value. Now, money, you can understand money is like a scale. You measure distance in meters, kilometers, miles. You measure weight of an object in kilograms, grams, tons, pounds. Similarly, you measure the value of goods and services in terms of money. So it's a scale, no doubt. But people also consider money as a storage of value. Unfortunately, money in short term is an okay storage of value, but in the medium to long term, it is one of the most inferior storage of values. And we'll see this later how. Money is also the biggest instrument of transfer of wealth in the global world, especially since 1970s. The transfer of wealth happens mostly from the working class to the asset owners. Especially in the last 2 decades, ever since the dot-com burst and more so prominently since the financial crisis of 2008, this phenomenon has been running unabated. The central banks, the sovereign governments, the commercial banks, in the garb of promoting financial stability, covering up the mess they created over the decades of excesses in the financial markets, has been using these tools, influencing the money supply to transfer the wealth from working class to the asset owners. And we'll study these tools, these methods in more detail in the coming episodes. Just to indicate some of these tools that they use: changing the supply of money in the economy, ensuring early access to a few, very important, and how this affects the transfer of wealth in the economy. Monopoly of money. Today, although since the advent of cryptocurrency, things hopefully would change in the future, but today, the sovereign, the central banks, the commercial banks have literal monopoly of the money supply in the economy. We say free markets, but are the markets really free is what we'll discuss in the coming episodes. When one half of the almost every transaction is done using that instrument, which is monopolized in the global economy, does that make really the markets free markets? And finally, the government control. This is exercised most through the taxation, the taxes that we pay the government in the sovereign currency. Now let's understand how money is created in the economy. First character that comes into the picture is a central bank. Central bank creates something called as reserve money. This money is created out of thin air, and we'll use the term thin air quite often because that's what is happening. Things are being created out of thin air. So central bank creates reserve money out of thin air. Now comes the commercial banks into picture. The commercial banks have something called short-term securities. These are essentially debt instruments that they provide the central bank as collateral, short-term, matures in very short duration of time, weeks, month, something like that. They provide them to the central bank. In lieu of those instruments, the central bank provides the commercial banks the reserve money. These are short-term loans, which are of course rolled over and over and over. Now, using that reserve money, the commercial banks then they also create money out of thin air, literally, using that reserve money by X number of times and lend out long term to the borrowers. So they borrow short term from the central bank and lend out long term to the borrowers. And as many of you might know, lending out money long term fetches more interest rate than taking money at the short term. Of course, the difference between the two is one of the ways the banks profit or make money. Then, also important to understand that if the question comes, how much money can the commercial banks create out of thin air? Well, they can. Everyone would like to theoretically print as much as one wants, but there are some limiting factors as to how much the banks can create, and we'll discuss these limiting factors in the next slide. And finally, and this is a very crucial point to understand, many of you might have the confusion that the money that you go and deposit in the bank is what lets the bank to lend. So let's say you deposit $100 in the bank. That would enable the bank to, let's say, lend out $100 or maybe $90. That is not the case at all. It's not a chicken egg problem. It's pretty clear. The banks, your deposits, are not creating the credit in the economy. It's rather the other way around. The credit that the banks create, or the money that the banks create, is what are creating your deposits that you're putting in the bank. The banks need the deposit, of course, to balance the books, to balance the balance sheet. They need the deposits, but your deposits are not influencing the banks to lend out. You have to be very clear about this. So let's go to the next slide. Of course, I'll just show you this using some figures and numbers to make these points very clear later on in this session. So as we discussed previously, factors that influence the creation of money by banks. We have something called capital adequacy ratio. Now this ratio is set by the central bank. In simple words, if I would explain this, it's, for example, a bank takes deposits to balance out its books, takes loans from the other commercial banks or institutions. It has some of its own equity in it, and the reserve money, obviously, that it takes from the central bank. Capital adequacy ratio would, in simple words, would mean how much of the bank's equity, or safer form, or its own money, is backed by the loans. So the banks, let's say, is giving out X amount of loans. How much of those loans are backed by the bank's equity or its own money? That, in simple words, is what capital adequacy ratio means. It's a little more nuanced than that, but in simple, that's what it means. Lack of worthy credit demand in the economy. The banks would be ready to print as much money as they want and lend out, but then the economy might not be doing good. The people may not be demanding. There may not be too many opportunities to demand credit in the economy. Not much demand in the economy, so the demand of credit itself is low. Stress on the balance sheet of banks. The bank financial condition may not be great to give out those loans, so the borrowers may have defaulted on the bank, providing stress on the bank's balance sheet and reducing its ability to give loans. The bank's capital adequacy ratio, for example, may not be good. Its equity reserves might be low. Some of these things can inhibit the creation of money by the banks in the economy. Or it could be even something called lack of securities. So as we discussed, that banks need securities to, for example, take reserve money from the central banks. Banks may be lacking those worthy securities. Or even the banks many times take loan from other commercial banks or institutions. But again, to take those loans, banks provide securities. The banks may be lacking those securities, thus limiting the ability of the bank to create money. Now, this table might explain things more clearly as to how banks create money in the economy. So, let's say the central bank creates $100 of reserve money and lend it to two banks, Bank 1, Bank 2. To Bank 1, it lends out $70, and to Bank 2, it lends out $30. Now, against those $70, the Bank 1 gives out commercial loans of $700. So essentially what I'm saying is that the bank is creating $630 out of thin air. Similarly, Bank 2, against $30 of reserve money, is laying out commercial loans of $300. So it's creating $270 of money out of thin air. Net, these two commercial banks are creating $900 out of thin air. Then what happens? Now, there are $1,000 in the economy. 700, 300 of the commercial loans and 100 of the reserve money. The depositors deposit $600 in bank 1 and $400 in bank 2. Remember, here adding the reserve money and the deposit would mean $670 of liability for the banks, while asset for the banks is $700. The bank has to balance its books. It's short by $30. And $20, let's say, is have cash. So similarly for bank 2, it has $430 of liability, just about $300 of assets and forms of commercial loan. Again, the bank has to balance its books. What happens is, also let's add the cash component to it. This bank has $20 of cash component, and this bank has $80 of cash component. So let's add them up. $670 of liability against $720 of assets. $430 of liability against $350 of assets. So how the banks will balance their books now? To do that, bank 1 will take a loan from bank 2. So bank 2 will give a loan to bank 1, and this is how it shows on its balance sheet. This will balance the books for the banks, and the economy will have $900 of surplus money that was created out of thin air. So this brings us to an end of episode 1 about money supply. In the next episode, we will discuss how the money supply under the government and central bank policies and the commercial banks leads to the biggest transfer of wealth from working class to asset owners. So till next time, thank you for watching.